All right, then let's welcome out the CEO of Everest, Vicki Schiff.
Thank you. Okay, I didn't say that thing about everybody come in the room, but that would be great. So nice to see everybody, and had a great time at the VIP party last night. Whoop, whoop. Okay, if Kyle was up here, we would say fight on. What does that mean? We went to SC, so fight on. I always love to start with personal stories because we're going to be talking about a lot of data, and your speakers this morning brought that into what they talked about, and I think that is super important. I have a clicker here, so let's see. How does this, there we go. Okay, so this is me at 3 years old. My dad was a developer in Las Vegas. He moved there in 1949. And this is me on the construction site of Caesar's Palace. He built, actually Circus Circus, he built Caesar's Palace and Circus Circus. So he dragged me to construction jobs and bank meetings from the time I was 3 years old. I absolutely hated it at the time, but I could say later on it made me so incredibly comfortable in the world of real estate and finance that I'm forever grateful for my father, who passed away when I was 19, giving me those early lessons. So for those of you that have kids, even though they seem like they're not listening at the time, you never know what your influence brings them. My career has been one of entrepreneurship, although I have worked with institutions over my career. This is basically my career from the time I started observing, I would say, my family business. I started my very first company after doing a stint in brokerage and acquisitions for an opportunistic investor in 1996, where I started a self-storage company. I was 29 years old. I was backed by a $5 billion family office. I walked in there with a business plan. I really didn't know anything about storage, but I knew a lot about real estate. They said yes after looking at about 2,000 business plans per year. And we built a company. We built 14,000 units in 4 states and sold that business. And fast forward from that, I had a company that raised capital. We raised about $7 billion from mostly public pension for the purpose of investing in both real estate and private equity. And my very last company was a company called Mosaic Real Estate Credit. We originated almost $3 billion across the US in not only multifamily pref equity, but also first mortgages and construction loans at a time where interest rates were basically zero. So we were able to deliver 1,000 basis point spread over interest rates to investors. And it was a great run. We sold the company to a public company in 2022, and thus started a new debt fund. I like to torture myself with this entrepreneurial endeavor. Started a new debt fund late last year, which we're now working on putting capital out. So this is an interesting chart because a lot of you have started your careers in this last cycle and have never experienced a downturn until probably a year ago. And I actually charted my career against all of these downturns in the market up until I started my 6th company last year. So what I learned, and Kyle was up here talking about it, that you develop certain habits that you simply have to be consistent about day after day after day, whether that's calling investors, whether that's looking at deals, whatever those habits are, that the outcome will be business creation. You have to do them even when there's no evidence. And part of being an entrepreneur is you have to work and move forward even sometimes when there's new evidence until there is. And then when you become very successful, there's a whole set of other issues that you deal with. But I just thought that was interesting. And this is just a list. It's very, very small. You can't really see it. But it's a list of recessions from the Depression through COVID and how long they lasted. So the last recession, which we would say kicked in post-COVID, where we're in a soft landing, or maybe not. The previous run was 10 years. So whoever started working here 12 years ago and experienced this little blip in the market, you've only seen a run-up, and you've only seen profits, as we talked about yesterday. And there's a cycle to market emotions. You know, you're excited, you want to get into the real estate business, you see somebody driving a Ferrari, everybody's making money, it's exciting, it's thrilling, you're closing deals, there's a sense of euphoria, and then things start to not go exactly the way you thought they were going to go. Your underwriting is missed. You're trying to figure out what to do. You sort of deny. There's some fear, turns into desperation, panic, hopelessness, and the whole thing starts all over after you get depressed, and then the hope gleams through the clouds once again. So this is just a simple cycle of market emotions. It could be in the stock market. It could be a lot of different asset classes. So what was last year? Last year, what I would say is a year of uncertainty, particularly in the credit and the real estate markets. So we don't have a crystal ball, but we could see what the current trends were. So the U.S. commercial real estate transaction volume cratered in 2023. Development was absolutely impossible to finance. I probably get 10 development requests a week. Very difficult to see how they could pencil. The cost of development and operations, we talked about insurance yesterday, continued to rise, meaning NOIs started to compress, and the indexes, treasuries and SOFR, are substantially higher now than when borrowers signed up for floating rate loans, if they signed up for floating rate loans. There's a wall of maturities coming that continues to grow, and inflation, has it peaked? We saw some numbers yesterday it's continued, and index numbers, I think treasuries are at 460, something like that today, and SOFR's at 530. And when you borrow against those indexes. So the best multifamily probably fixed rate loan you can get on a small balance loan today is probably in the high 6s, low 7s. So you're going to buy at a 4 cap? That's a tough one. So this is the SOFR trend over a period of time since 2019. And we've seen that SOFR has stayed above 5.3% since late July 2022. What does that mean for people who took out floating rate loans that had an interest rate increase, or they bought insurance and their insurance is now burning off? If you were at a 1-2 coverage, so you had $120,000 of NOI, for example, and your payment was $100,000 and your rate was 4%, well, now your payment may be $150,000. So you're way under your debt coverage ratio. So your lender's going to call you up until you pay down your loan. You're out of balance. Freddie Mac, this is the primary mortgage market survey, and we went from, we're about a 6.82% 30-year fixed rate mortgage today. At about a 606.15. So again, making those numbers work on old values is very difficult. So what happened in 2023? There were funding gaps. So the unprecedented velocity of interest rate rises put a lot of stress on all asset classes, and regulatory pressures continued to drive banks to retreat from the market. And banks and some of the big institutional lenders, don't forget, maybe not in this room, but they hold a lot of office. They hold a lot of office loans because that was the institutional darling asset class for many, many years. Who knows what an interest rate cap is? Who has bought an interest rate cap? You bought an interest rate cap. So interest rate caps used to be pretty cheap, right? And the markets got so competitive that your lender may have said to you, oh, we're okay if you buy a 1-year cap or a 2-year cap instead of a 3 or a 4-year cap. And it'll cost you $50,000, $100,000. But now your cap's burning off. That same cap may cost you $1 million, $2 million, depending on the size of your loan. How are you going to deal with that? Are you going to go to your investors and ask them to come up with more money? Or you can pay down your loan so your debt coverage ratio is within the covenants. All of this has resulted in declining values, but assets are still stuck in the market. Stuff's not trading quite yet in the way that it should. So what happened in the post-GFC, alternative lenders came into the market. Who here has used an alternative lender? A debt fund, private lender? Anybody in here? You've used an alternative lender. So there's been a proliferation from about 5% of the market in 12 to about 16% in 22. That's a 10-year run-up of people raising private debt funds, and I'm also including mortgage REITs, publicly traded mortgage REITs. So traditional lenders have tightened their credit standards, and capital gap was filled by these non-bank lenders. What happened? Borrowers enjoyed lots of liquidity, easy money, low interest rates, and then COVID hit, which devastated a couple asset classes, but helped industrial and multifamily. The work from home really changed, so office, everybody, I don't have to tell everybody the story of office in this room, and stimulus caused inflation, right? A lot of easy money poured into the system. People started buying stuff, and inflation hit. Then we had issues with getting goods to the U.S., right? So goods were scarcer, and again, harder to get, so inflation went up. And then, really, the pace of the rate hikes in 2022 caused the market to grind to an absolute halt as liquidity tightened. And sponsors, meaning people in this room, with debt maturities faced a very difficult refinancing market, particularly if they were trying to replace their existing loans. And that forced the debt coverage ratios to fall. So if generally you're at a 1.2 debt coverage ratio, if you're under that, you're out of compliance with your loan. And the lenders themselves had to navigate these delinquent loans. So what did they do? Some of them, particularly in multifamily, went to their borrowers and said, we'll give you a little bit more money, but you're out of the equity. We'll let you look like you're still the manager of the asset, but you're wiped out. Your basically balance on your equity is zero. And maybe you have to keep funding this asset. But perhaps we'll let you, quote, asset manage it or property manage it, but you're wiped out. What are you going to tell your investors? How many people in this room ever ask their lenders how they're financed? Nobody. So private lenders and mortgage REITs use something called repo lines, warehouse lines, CLOs, meaning as a lender, I'm borrowing money too. So if I do a floating rate loan, I would borrow on a floating rate loan as well, and hopefully I'm making a spread on that. But everybody in this room should understand how their own lenders are financed, so because that puts stress into the overall market. And all of this results in, obviously, transaction volume decrease. And their borrowers and lenders are both parties are in this protracted holding period. And what do? The Fed's working to control inflation. Owners with existing projects are missing the mark on the costs and the NOIs. And owners themselves are absolutely hunger for debt that remains unsatisfied. And the industry as a whole on the CMBS side also reduced issuances. So CMBS is another form of financing. And the Commercial Mortgage Alert Survey wrote in 2003 that the projections for CMBS issuance was $64.98 billion, but the actual amount issued was not quite half, but almost half of that. And for 2024, it's predicted to go back up to about $50 billion. That's a lot of the market. And that's about half of the peak of the CMBS market. So again, another, you've got banks that are facing regulatory issues. You've got debt funds and mortgage REITs that are facing their own borrowing issues. You've got a drop in CMBS issuance. So that bodes well for maybe somebody that's starting a new debt fund, as we've heard a couple of other people talk about this past couple days. So what's the Fed's next move? What happened yesterday? Did inflation look like it was going up or down? Up. So what do you think the Fed's going to do this year? Are they going to have 3 rate cuts? I mean, nobody in this room absolutely knows what the Fed's going to do. But they have a tool, and their tool is rising interest rates. I had a meeting with a very senior person in the Fed, and they said to me, well, commercial real estate's only a tiny bit of the overall economy. We're not focused on it. They're not going to do us any favors because we're suffering. And holding current rates may result in a slightly improved environment versus 23 just because there's more certainty in the market. And transaction volume did pick up a little bit at the end of the year. Although, I don't believe traditional bank lenders are going to re-enter the market in a big way, other than maybe some community banks that a lot of you may deal with on an individual basis in your micro markets. Regulated lenders need to clear their non-performing loans. Again, a lot of these big regulated lenders are in office, especially, and so are insurance companies. They need to clear that out. How are they going to do that? I talked to a friend of mine who is one of the largest loan broker salespeople at CBRE, and he said in 2022, he was getting calls from insurance companies and banks on 2 things, but BOVs and what's going to happen next, a broker opinion of value. These lenders wanted to know, how much is this property worth? Now they're calling him, asking him, how much can I sell my loan for? You're seeing some loan trades, particularly in asset classes like office, trade at 50 to 70% below the loan amount. And it's not hitting multifamily quite yet, but there's been some big FDIC trades, particularly with Signature Bank, that did result in some decreases or some discounts to the overall pools. So, covenant violations, cap rate expirations, and loan maturities really began resulting in workouts in late 2023, and we're starting to see some foreclosures, and we expect this to considerably accelerate in 2024 as part of the natural healing process of the market. Again, if you have a lender with no legacy assets or no legacy issues, they're in a much better position to step into a market like this because values on multifamily probably have come down between 10 and 30%, so they get to lend with better covenants, not as competitive, probably a pretty healthy rate, although for really good assets, there's still good competition. But you're still talking about 200 basis points over SOFR, so you're going to be paying 7 to 8 to 9% for your loans. And we have a lot of outstanding commercial mortgages held by lenders that will mature in 2024, as I said. It's a 28% increase from the $729 billion that matured in 2023. So what is a rate cap and maturity? $52 billion of loans, or 3,000 properties are expected to mature where the debt service coverage ratio is 1.25% or less. 17 billion of underlying properties have an occupancy below 80%. So this is an indication of broader issues in the commercial real estate market, and it could go to affordability, and if you're an owner that you can't make distributions and you don't have any cash flow coming in, are you going to go fix your sidewalks? Are you going to go restripe your parking lot? There's degradation within your asset that's going to be happening, and I've heard many, many stories about that. Workouts and extensions, defaults leading to foreclosure, some loan sales, and sponsors are just faced with an environment where you have a higher interest rate. So for those that have never been through this before, Bringing in fresh capital could be an option. If you think your property's really worth, what you paid for it, but you got to wait 3 or 4 years, you have to figure out how to bridge that gap in the short run. And then all these rate caps are due to expire. We talked about that. And from when the global financial crisis hit from about 2009 to 2012, all that distress worked its way through the system. But it took 4 years. We're at the beginning of what's happening now. And we've heard, I assume, some of these bank sales and takeovers of portfolio. So PacWest was a big multifamily lender on the West Coast, and they sold off almost $6 billion of their construction book to Kennedy Wilson, and $1 billion of a portfolio backed by New York office was also sold in another transaction. We'll see more loan sales and workouts as we go through this year. The fall of Silicon Valley Bank, First Republic, and others spurred that further loss of confidence in the banking system. And I heard there was a great presentation on bank failures during the conference. I missed it. But the Fed backstopped this. They arranged for deals to happen, right? They arranged for some banks to be bought by others or portfolios to be sold. And they don't want the system to crater on itself, but they're not too worried based on my conversations with some of the people in that industry. These are some lists of some of the bank failures in 2023. This is an interesting slide because these are the maturities per year that are forecasted. Why do I say kicking the can? The light blue line are actually extensions that were negotiated between the borrower and the lender. So lenders are negotiating with borrowers to try to keep them in their property, but at some point, they're going to lose patience. This is a CRE loan maturities by lender type. So if you think there's an opportunity for you to go to a bank, community banks are good grounds to have conversations with. They're a little bit easier to get in the door and try to buy loans. You have to be prepared for foreclosure and that process, which is a legal process that's very, very, very different from owning a piece of real estate if you want to get into that industry, and this is by property type. Interesting fact, just wanted to talk to the audience about, again, how lenders actually finance their own loans. So anybody that doesn't listen to Trepwire should listen to Trepwire podcast. They track the CMBS data, and they say about 2/3 of CLOs, which is a pool of loans that gets sold into the market, are on apartment projects nationally. More than half of the CLO-funded multifamily projects operate with a negative cash flow. In some metro markets, this distress is staggeringly high. The Denver market, 95% of the apartment CLOs aren't generating enough revenue to cover their debt service. In Washington, the figure is 90%. So the lenders are having their own stress, which is caused by things happening on the ground at the property level. So what's the opportunity? Overall, values have dropped. There's been devaluation. There's an opportunity to get into a property at a lower value, which provides a marketplace for well-capitalized both borrowers and lenders. And although we had muted competition in 2024 or 2023, we believe 2024 will start a slow thawing, but it will last for years. And long-term demand for housing is still important. Also, on the industrial side, if you're in the industrial business, goods being moved throughout the country is still a robust market. Supply issues, labor and material shortages, et cetera, rising construction costs will abate, and sponsors still need bridge capital to pay off construction loans, which are maturing as well. Loan sales will continue, and lenders who will capitalized will have an opportunity. Takeaways: the Fed appears finished, maybe, with rising rates, and those we believe will start to cut at least once this year. And the health of the system is expected to improve. Bank marks are decreasing. Pressure on cap rates is declining. Carrying costs in general, other than insurance, is trending lower. And a sponsor's incentive to inject fresh capital could be there in 2024. And transaction volume, although will still be muted by issues in the system, in 2024, there's opportunity, and blend and extend is something, if you have an issue with your lender, have conversations early. And overall, the prospect of lower rates is the light at the end of the tunnel, and legacy issues will move this system, and who knows what's going to happen with the presidential election. I will absolutely leave it at that. I am happy to talk to any of you after the conference, after the event today, and I'll be at the lunch, and thank you very much.
Thank you so much, Vicki. Another round of applause for Vicki. Awesome. Thank you so much, Vicki, for being here.